Hey guys, welcome back to Everyday Money. Normally on this channel we talk about saving money, we talk about investing money and what things cost over a long period of time, opportunity cost missed, but today we are going to be talking about buying stuff and how to buy things with the best financial outcome in mind. And what we're going to get into today is mostly buying big ticket items like cars, houses, toys such as ATVs, boats, campers, pools, whatever. And we're going to talk about the different ways that you can buy these items and end up financially in the black versus, just spending your money or putting it on credit. So it's generally regarded that there are just two ways to buy any type of item, and that is cash or credit. I see a lot of people on the internet arguing about which way is better, and a lot of folks are saying that, cash is king, and I don't have a payment, and my way is better. And then the other people will say, well, I want it now, my credit can get me this, I'm going to put it on credit, and, I'm going to do whatever. But there's a third way, and it's very powerful. What this way does for you, it's by putting something on credit, but also having the cash for it and investing that cash into some sort of an investment so that it grows in size while you pay for this other item that you may have. The cool part about that is that you have your money available. So if there is an emergency in your life, whatever, or if you just get tired of paying for it, you can just take that cash and boom, paid off. It's done. But if you can just leave that money in an account, it will grow to a much larger amount than the original amount of cash that you have. And so if you have the risk tolerance for this, and if you have the income to make the payments, I'm going to put a few examples here for you of common things that people buy where that'll show that buying something with having the cash invested but buying it on credit just absolutely crushes buying either with cash or with credit alone. Now the examples I use are just examples, but really they apply to any large ticket item that you're going to purchase. It doesn't really make any difference, but I'm just going to use some common ones here. So the first one I want to show you is a new car. Someone wants to purchase a new car, and you might say, well, buying a new car is stupid. Well, it doesn't really matter. This could be a used car or whatever. The dollar amount is really not that important, but the average new car in 2020 is going for $38,000. The average depreciation in 5 years, which is the typical new car loan, so a 60-month loan, 5 years, is 60% of the value is gone after 5 years. So if you go and you buy that car in cash, you lay down $38,000, you don't have a payment. And that's cool. Not having payments is awesome. And if you're one of those people that doesn't like having a payment, more power to you. But you paid your $38,000. You have $0 left, but no payment. And in 5 years, your vehicle will be worth $15,200. So that is what you have in an asset. Be it depreciating, but it's still an asset in 5 years, $15,200. If you go in and just purchase it on credit, let's say you have no money but you need a new car for whatever reason. A lot of folks live in places where they have to have cars, suburbs, whatever, just to get to work, just to make ends meet. You have to have a car. So you're like, I'm going to go out and I'm going to buy a new car. It's reliable with a warranty and the whole deal. And you take that $38,000 car. You take a 60-month loan at 3% interest. All total, you're going to pay almost $3,000 in interest. So the amount that you're going to have into that car altogether is going to be $41,000. But now at the end of that 5 years, your car is still only going to be worth $15,200. But then you have to minus that $3,000 interest charge that you had to pay in order for the bank to give you a loan on that vehicle. And so your total value at the end of that 5 years is only going to be $12,200. So, you're $3,000 less than your cash purchase guy. But you've got your car and, you're in good shape. And really, $3,000 over 5 years probably isn't that big a deal. Even better if you can find a car for 0% financing, and then, you're basically in the same boat as the guy that paid cash, and that's why they call it same as cash. So here's where things get crazy, and this is awesome. If you take that money, that $38,000 cash that you had, and instead of paying for that car in cash, you financed it at 100% financing, same loan, 3% for 60 months, but you took that $38,000 and you put it in an S&P 500 fund or anything else that reliably returns 10% annually. At the end of that loan period, your car is still going to be worth, the $38,000 car is still going to be worth the $15,200 that everyone else's car is worth. Now, you've taken that on credit, so you'd have to take off that $3,000 interest fee that you had to pay to get that bank to give you that loan. So, again, your vehicle in the total amount that you've paid, is now going to be worth $12,200. But that money that you invested for 5 years at 10% return will now be worth $61,200. So if you add that amount, that $61,200, to the $12,200 that your vehicle minus the interest that you paid on it is worth, you now have a total value of $73,400. As you can see, that trounces the cash payment, that trounces, credit only. The cash buyer does pay the least amount for the car. He is only going to pay $38,000. That's it. No ifs, ands, or buts. And obviously, I'm discounting taxes, title, license, fees, all the other, stuff, because that's going to vary depending on where you are. But the cash buyer pays the least. The two credit buyers pay the most for the car by $3,000 more than the cash guy does. But at the end, the investor money, but finance the car at 100% financing, easily wins on the finances at the end. I mean, it just blows them away. So let me give you an even more dramatic example. And this one is personal to me because I'm doing it right now. We are going to put a pool at our house. And so I had budgeted about $50,000 for this upgrade, including the pool, fencing, concrete, all the stuff that you need, to legally put a pool in. Now, I have this money in an investment account. I have it invested in VTSAX, which is a total market fund from Vanguard, and it returns about 10% annually historically. Now, if I would pay cash, I wouldn't have any payment. I wouldn't have any increase in my mortgage payment, and I would pay 0 interest on the entire deal. If I were to refinance my home, which is what I did, at 2.875%, pull $50,000 of equity out of it, I would end up paying about $24,680 in interest over the 30 years for that $50,000 pool. So altogether, it ended up being like $75,000 over 30 years. And I can see the people with the cash people, their heads are just exploding because, I'm going to pay almost $25,000 in interest on this. However, when I put the pen to paper, or, I actually did it on the computer, my $50,000 invested in VTSAX or really any other fund that would return 10% over 30 years would have a value at the end of that 30 years of, and now wait for it, this is crazy, by me doing nothing at all other than just leaving that money in there, $872,470 at the end of that 30-year period. So if you take out that, almost $25,000 that of interest, we're talking about an $850,000 swing to the black. And that's, a no-brainer to me. What's even cooler about this is if I would leave that $50,000 in that account for approximately 7.3 years, I would have enough money that I could pay off the $50,000 mortgage, the extra that I had paid on, or that I had taken on my mortgage, and still have my original $50,000 in that account still, because money in the market will double approximately every 7 years, or a little bit longer than every 7 years at a 10% return. So again, in just a little over 7 years, I could pay that completely and have my money still just sitting in my account. All these things make financing these large ticket items and investing your money in the markets a no-brainer, much better way to purchase things and get ahead financially, and still have all this cool fun stuff that you want to play with. However, all of this depends on your level of risk tolerance. Obviously, there could be some sort of market crash at some point. Maybe the markets don't return the 10% over the time period that you need to. Although historically there's hundreds of years of data that says that the markets return 10% on average. But if you have a low risk tolerance, if you like just paying in cash, not having a payment is sweet. Like, I get it. I've done it on several things before in the past. When I haven't put pen to paper, I just paid cash, and it feels good to just buy something and not have a payment. But I am now less farther ahead financially than I could have been had I have used this technique. In addition, you still need to have the income to be able to make the payments and not have a gigantic stretch on your budget. If it took you, 20 years to save up the $20,000 that you wanted to spend on this ATV or a boat or whatever, and you don't make much money, it wouldn't make a lot of sense to take something on credit that is going to just put you in a bad position. Because these items, these fun items, won't be much fun if you're stuck working all the time and they cause you a lot of stress. So that's the biggest deal, is that you need to be able to easily make these payments while letting your money work in the market. However, if you do have that money in the market and something does, go awry for you personally or whatever, and the markets are still doing well, or it's been a while, even if they're doing poorly, that amount is still in there plus whatever returns you've gotten, you always have that option to just take that money out of the market and just pay it off right away. Again, it just depends on your level of risk tolerance, and that is, for each person to decide for themselves. So there's some food for thought for you all. If you've never thought about that third way to purchase an item, give it some thought. Get on the internet, get on some calculators, look at what opportunity that you're costing yourself by paying cash for something instead of financing things at low interest rates and investing the money. If you guys like this content, like videos like this financial stuff, be sure to subscribe to grow your wealth, increase your success, put you on the road to financial freedom. Be sure to like this video. It really helps it within the YouTube algorithm. I appreciate you guys watching today, and I'll see you on the next one.